There's an interesting phenomenon with investors. When a stock is underperforming, investors tend to only focus on the negative. When a stock is outperforming, investors tend to only focus on the positive. Blinders get put up, and that stock that is underperforming, all of a sudden it's a horrible investment and it's time to sell, sell, sell at all-time lows. And when the opposite happens and the stock is outperforming, it's an amazing investment and it's time to buy, buy, buy at all-time highs. This sounds like FOMO. On social media, when a stock, or shall I say an ETF, in this case SCHD, is outperforming, all you hear is praise and how it's the best ETF ever. But when it's underperforming, those same people change their sentiment and you see nothing but posts on how horrible SCHD is. And there are so many other better performing ETFs, and basically you're stupid for holding this fund. The wave of the stock performance chart mirrors the wave of investors' attitude and point of view. Not the best way to invest, in my opinion. Well, I'm here to say stop bashing SCHD as well as certain stocks right now like Realty Income. Bashing SCHD and Realty Income is a very popular thing to do right now. Like I said, it's interesting to see how the performance of an investment mirrors the articles that come out and social media posts that we see. I wonder if those articles have something to do with getting views, as they are geared towards riding the wave of popularity and getting profits. Gee, who would have thought? Of course, it's easy to bash a stock when it's underperforming and praise a stock when it is outperforming. It makes anyone look like a genius at that moment, but long term, not so much. I think it's valuable to have independent thought. It's also dangerous to follow the masses. I'm seeing people sell out of SCHD because others are saying to do so right now. Well, what do you think will happen when SCHD breaks into the $80 range in the future? You will see a lot of regret as posts about how you should have held on and it's the best ETF out there starts to make its circulation on social media. Just to prove a point here, right now it's underperforming. You can find plenty of articles like this. This one says a really poor way to get yield and strong returns. But if I go back and search during a time of outperformance, it's very easy to find positive articles like this one where it says SCHD is a dividend growth investor's dream ETF. So of course many are saying to move to growth, such as an S&P 500 fund, but don't think it's not had its own dips, and the same kind of sentiment and reactions occur when people sold out and regretted it later. You'll see here the S&P 500, I circled 4 big dips, and if you would have sold out and not have held, you would have missed out on some massive gains. I'm not here to say that SCHD is better than the S&P 500 funds out there. Rather, we all need to respect investors' individuality and realize each investor has different goals, is at a different age in life, and has different risk tolerances, etc., etc. I absolutely think it's great to have a mix of quality ETFs and stocks. That's diversification, and that's protection on your portfolio. If you have done your due diligence as an investor to research a fund or stock and it fits your goals and you are bullish on it, don't let someone else on a post or a Seeking Alpha article that shows opposing viewpoints every day dictate your decisions. I've seen way too many investors lose out on massive gains because they became emotional as they listened to others instead of themselves who put the time in to pick a quality investment. Of course, fundamentals of a company can change and personal goals can change over time, but overall investing should be a long-term goal, not a gambling game of timing short-term movement. As prices rise, people want to jump on the bandwagon and therefore are more likely to be overpaying. As prices decrease, people want to sell, and that usually results in a great buying opportunity that is missed. The higher the number of people seeming to believe something, the less likely we will scrutinize the claim. By going against the crowd, you may find new opportunities and see cracks in the popular opinion. I've seen people say that SCHD is just not the same anymore. Well, this is an ETF with an algorithm that has not changed, and that is it invests in stocks selected for fundamental strength relative to their peers based on financial ratios. So to bash an ETF or stock just because its ups and downs of the stock chart don't look great at a moment in time is really a narrow way to look at things, and unfortunately could lead to emotional decisions by yourself and others, creating potential losses and missed opportunities. You are also bashing someone else's investment without knowing their purpose for investing in the fund. So regarding SCHD, let me just point out a few things some are forgetting in this ETF's time of underperformance, something all investors face at one time or another. So I'm going to compare these 5 funds. Of course, we have SCHD, we have a Vanguard high dividend yield fund that mirrors SCHD. We have an S&P 500 fund, VU. We have a large cap growth, SCHG. And then we have JEPI, which is a very high yielding equity income ETF. And what I'm going to show here is in a certain point of performance, I circled the ones that outperformed out of all the others. So for a one-day performance, JEPI won, but that to me means nothing. The year-to-date, SCHG has won, and with a one-year total return, SCHG also won. But you take it out to 3 years, you'll see SCHD was the clear performer, the winner at that time, for that time frame, shall I say. Now these all have low yields, the 4 out of the 5, JEPI's the highest one, and I don't like to invest in high net expense ratio funds anyways, but what this tells me is that the market fluctuates. It always has, and quality investments will have their day in the sun, and they will have their cloudy periods as well. If you buy and sell based on the crowd, that's a good way to lose money because it usually involves buying high and selling low. That's not a great way to invest. Also, rates dictate the market, and right now, the environment for dividend-focused investments like SCHD and certain individual stocks like Realty Income is one of the worst scenarios that we are seeing right now as people flood out of the market into bonds and other alternative non-stock market investments. So when the Fed starts to lower rates, which may be a while due to their recent meeting saying rates will stay higher for longer, but what do you think will happen when those rates do decrease at some point in the future? Well, I think funds like SCHD will start to ride the wave up as investing dollars come back to the stock market looking for dividend-focused funds like SCHD as bond yields decrease. There will be that shift someday. But now I think is that opportunity. So I do think now is the time to accumulate shares of a high quality ETF at a relatively fair to low valuation compared to its history. We'll see here its yield chart over the last 10 years. It is paying out one of the highest yields it has over the last 10 years. There's only a few points that have gone higher. This is a great sign, as well as if we look at this chart, this shows its dividend growth over time over the last 10 years. And you draw a line through this, it's going to be a line increasing and going up. So you have a yield that is at historical highs, a dividend that keeps increasing with a stock that is underperformed. And to me, it's offering a buy right now at a close to fair value or slightly undervaluation right now. And long term, this is a win for investors who want healthy and growing passive income with some added benefit of growth at these buy-in levels. So if you're bashing SCHD, you're also bashing companies like Amgen, AbbVie, Pepsi, Chevron, Coca-Cola, Pfizer, Texas Instrument, Home Depot. This is the top 10 of SCHD. Now, Amgen is a leading biotech company with 3.27% yield and has raised its dividend every year in the last 5 years. Home Depot is a great company with stable growth and a 2.7% yield. AbbVie has had strong growth and has a yield of 3.9%. Chevron is an energy company which adds diversity and it's needed by consumers and has a 3.6 yield currently. Coca-Cola is a stable, well-known, solid company with a 3.2% yield. Verizon has a very high 8% yield. This company's been knocked down, but it's a needed service with upside potential in my opinion. Pepsi is a stable defensive name with a 2.8% yield. So these are very defensive safe companies that offer growing yields with some growth opportunity within each, some higher than others of course, but this is yield protection. This is passive income protection for us. Don't forget this is passively managed and the fund rebalances often. Again, it aims to invest in stocks selected for fundamental strength relative to their peers based on financial ratios. So yes, you can get better short-term yield in cash and bonds or growth in tech stocks, but with a slowing economy and a possible recession, who do you think will suffer more in a sell-off? Growth or SCHD? Not SCHD. SCHD offers stability and dependable passive income. SCHD proved to handle the pandemic sell-off better than the average stock and especially growth stocks. Long-term, SCHD does perform well, and that's the name of the game while adding safety and protecting your hard-earned investing dollars. It's a more conservative investment, and that's a good thing to have a portion of your portfolio in to have downside protection. Of course, people see this as a retirement stock and geared towards those that are older, but for younger investors, it's a great way to take advantage of compounding, meaning starting to invest now in a fund like SCHD, long-term with reinvesting dividends, it will pay off. this increases your position over time, and the increase of your position accelerates with time as well. So I don't see this as only an ETF for those close to retirement. It is also a compounding tool for younger investors. So you can bash SCHD or Realty Income if you want to, follow the crowd, or you can have some independent thought and see an opportunity, as well as realize this fund has been a solid performer historically, and that is what many investors like about SCHD. So to bash those that hold this ETF is just short-sighted and emotionally driven. I am all for some healthy critiques, as we should all be willing to see both sides, and that makes us great investors as well. So for me, here is my portfolio, and you will see that I hold SCHD, and it's only one tool in my investing toolbox. I'm focusing on diversification between growth and stable, higher yielding passive income. I am also diversified between sectors, and I have concentrated my portfolio down to the amount of holdings I feel creates better growth opportunities. I still have work to do though to make it better. So if I said I'm invested in SCHD and someone bashes me for my decision, well, they are probably not considering my other holdings, the allocation of my holdings, and don't know my strategy for long-term wealth creation, because I'm not willing to risk my profits and success by letting social pressure cause fear, leading me to sell, or greed causing me to buy at the wrong time. We need to think differently. We need to think smart, and sometimes that means drowning out the noise and sticking to your strategy and learning as much as you can. So yes, there are lessons to be learned and shared, and successes to be praised and adopted, but never veer from your core investing strategy. Instead, be patient and only make changes when you're absolutely confident in your decision and reason why. I mentioned real estate with the REIT Realty Income. I just want to say the era of low rates driving high levels of transactions is likely over, and will be replaced by an environment characterized by higher income yields and normalized levels of transaction activity and occupier demand. Realty Income, I believe, has shown to be a solid performer even through recessions, and with them diversifying into gaming and increasing their acquisitions lately, to me this solidifies a quality REIT that will survive and thrive, and I have been averaging down lately. So ignore the bashing and focus on the investment, as I think this is one offering a great opportunity, as well as SCHD. The only thing I'm going to bash is the extra air they are charging us in bagged chips. So that's all for today. Be sure to subscribe if you like this content, and see you soon on Mark Arnold's Finance.